AI bubble fears hit stocks.
The US economy is being propped up by an industry that's losing billions of dollars a month. AI infrastructure accounts for 40% of GDP growth, but the entire boom runs on a financial perpetual motion machine. Companies borrowing money to buy products from companies that are investing in them, or collateralized by rapidly depreciating GPUs that are sitting in cardboard boxes because there's no power to plug them in. The question is, can the maths behind the $1 trillion buildout survive contact with reality? My name is Nick, and you're watching Coin Bureau Finance. First things first, nothing in this video is financial advice. I'm just asking how the most important sector in the US economy was built on a human centipede of IOUs and soon-to-be obsolete GPUs. So, smash that like button and let's get some answers. To find out just how badly this is going to end, we are going to take a look at a forensic audit of the data center industrial complex. It's a report titled Bubble or Nothing from the Center for Public Enterprise. And they traced project financing, which is the invisible plumbing of debt and equity that allows these data centers to be built. What they found is terrifying because of how heavy the load has become. Right now, AI investment accounts for 40% of all US GDP growth. The Magnificent 7 tech stocks now make up 50% of the entire S&P 500 market cap. At this point, if ChatGPT sneezes, the whole economy is going to go to ICU. Now, you might be looking at Nvidia's latest earnings beat and thinking, Nick, what bubble? The line is still going up and to the right. But this only tells us the spending phase of the mania is still accelerating. The band on the Titanic is playing louder than ever, but we're looking at the hole in the hull, not the party on the deck. And here's the trap. We're all unknowingly leveraged into this trade. You've got pension funds pouring money into private credit firms, which are then lending to startups to buy GPUs at 17% interest. Governments are handing out tax breaks, betting their budgets on data center growth. And the ETFs in everyone's portfolio are magnifying exposure to companies whose revenues depend on other companies, whose revenues depend on them. The US economy has levered up to the eyeballs on this trade, leaving much of the world exposed in the process. The report looks at these facts and asks a simple question. What happens if the cash flows everyone is betting on never show up? Well, I've got good news and I've got bad news. The good news is we don't have to wait for an answer to that. We can find out by looking at the balance sheets today. The bad news is that we've seen them and they are diabolical. More on that in a second, but I do have one more piece of news for you first. If you're active in the markets, you've probably paid some diabolical fees buying, selling, and moving around assets. It doesn't have to be this way though. If you head to the Coin Bureau deals page, you can take advantage of the many exclusive deals and bonuses we have secured to help you keep more of your gains and pay less of the fees that eat away at them. To find out more, scan the QR code over here or hit the link in the description. Now, these offers won't last forever, so take advantage of them ASAP while you still can. Back to the video. Let's start with the core problem. There's a $500 billion hole between what's been spent on AI infrastructure and what's been earned from it. The hyperscalers, Microsoft, Google, Amazon, Meta, spent $560 billion between 2024 and 2025 building out AI capacity. Their actual revenue from AI services over that period? $35 billion. OpenAI, the poster child of the AI revolution, is burning through $3.8 billion per month. The mind boggles. So why do they keep on building? Well, the answer is what the report calls, quote, defensive capex. They're not buying GPUs because they need them. They're buying them to deny them to competitors. Hoarding chips creates artificial scarcity, inflates demand signals, and forces rivals to either overpay or fall behind. It's completely unhinged, incredibly wasteful, and primitive bubble behavior. Buying assets not for their productive use, but to prevent someone else from having them. And this creates a prisoner's dilemma that's digging everyone involved into a very deep hole. To grab market share, companies are slashing inference prices, offering unlimited use models while costs keep climbing. They're subsidizing customers to juice user growth metrics, burning capital to buy legitimacy. Nobody can dare to charge what AI actually costs to run, because the first company to price rationally loses the land grab. And the costs aren't falling the way everyone promised. Yes, chips get more efficient, but prompts get more complex. Users demand triple-checked outputs. They want cross-instance memory, bigger context windows, better image and video generation. The race for the latest GPU generation means nobody can coast on last year's hardware. Any efficiency gains get devoured by the escalating demands of what counts as good enough. Since good enough, especially for the all-important enterprise market, is at a minimum an AI that doesn't routinely hallucinate a structural flaw inherent in large language models, this is a race with no end in sight. It's a subsidy war nobody can win. Every hyperscaler is lighting money on fire to capture a market that might not exist at profitable prices. They're building for a future where AI generates trillions in consumer spending, which needs to happen basically immediately to justify the buildout that's already underway. The maths is not on AI's side. At current revenue run rates, it would take decades to earn back what's been spent on infrastructure. The entire thesis depends on a hockey stick inflection in consumer willingness to pay that shows no sign of appearing. Enterprise customers are experimenting. Consumers are playing with free tools, but nobody's opening their wallet wide enough to fill a $500 billion gap. The Apples and Samsungs of the world are paying hemorrhaging cash just to shoehorn AI features into their hardware. The number of people who asked for, wanted, or care about these features is not only tiny, it's also shrinking. Well, the plan might eventually work. Maybe AI does transform everything and the revenue materializes. But right now, the industry is running on vibes and venture capital, not actual cash flows. And that brings us to the collateral supposedly backstopping all of this spending. The entire AI boom is financed by loans backed by GPUs, hundreds of billions in debt, collateralized by silicon chips that are supposed to hold their value long enough to repay the borrowing. There's just one problem. GPUs are terrible collateral. An NVIDIA H100 that rented for $8 per hour 18 months ago now rents for $1 per hour. That's an 87% collapse in revenue generating capacity. I've seen dog memes hold their value better than that. So the asset back in the loan has just lost most of its value, but the loan amount hasn't changed. It's like the housing crisis in miniature, except the depreciation cycle runs in years instead of decades. And it gets worse. Utilities across the US are now reporting ghost interconnection requests, developers buying chips for data centers that can't actually be powered. There's a queue of projects waiting for grid connections that might take years to materialize, which means GPUs are literally sitting inside cardboard boxes, depreciating, waiting for electricity that may never arrive. The depreciation clock starts ticking the moment the chip is purchased. If it sits in a warehouse for 18 months waiting for a power connection, it's lost half its value before running a single computation. And this is one of the reasons why NVIDIA has moved to yearly release cycles. It used to be 2 years between generations. Every GPU now has a shorter window to earn back its cost before the next generation makes it obsolete. The accounting is designed to hide this. CoreWeave, one of the largest GPU cloud providers, depreciates its chips over 6 years, and this is despite the actual useful life being just 3 to 4 years. By extending and pretending, they can smooth earnings numbers and show steady profits. But the book value on their balance sheets bears no relationship to what those assets would fetch in a fire sale. Hyperscalers are extending their depreciation schedules too, stretching the timeline to make quarterly earnings look healthier. The gap between what's on the books and what the assets are actually worth keeps widening, and everyone knows it, which is why the newest tactic is to lease instead of buy. OpenAI and xAI are now leasing GPUs rather than purchasing them outright, and this keeps the depreciation off their balance sheets entirely. The problem just gets pushed onto NVIDIA or whoever's financing the lease. But that just moves the risk. When those leases expire in 5 or 6 years, a massive glut of older chips hits the secondary market all at once. And Nvidia, having effectively financed its own sales through leasing arrangements, is left holding depreciated assets it can't sell. And the really elegant part, if you can call it that, is what happens when companies use GPU-backed loans to buy more GPUs. It's the kind of financial engineering that would make Michael Saylor blush. The collateral loses value faster than the debt gets repaid, which means you need to borrow more just to stay current. And this works great as long as GPU prices keep climbing and demand stays infinite. The second either assumption breaks, the whole structure inverts. And this brings us to the truly beautiful part. Everyone involved is financially dependent on everyone else staying solvent. OpenAI pays Oracle $300 billion to use GPU capacity. Oracle then uses that contract to borrow money from banks to buy NVIDIA chips. NVIDIA then invests, quote, up to $100 billion in OpenAI. The money goes in a circle, each transaction justifying the next. Everyone's balance sheet dependent on everyone else's continued survival. Except NVIDIA's investment isn't actually cash changing hands. It's vendor financing, a credit line that OpenAI can use to buy NVIDIA's products. NVIDIA is lending customers the money to purchase their chips, then booking those purchases as revenue. They're printing their own sales numbers, and this is the corporate equivalent of a car dealer offering you a loan to buy their cars and then celebrating record sales. In their latest earnings call, NVIDIA celebrated a new deal with Anthropic, where they invest $10 billion in Anthropic, and Anthropic commits to using NVIDIA chips. But there you go again, moving cash from the left pocket to the right pocket, creating valuation multipliers for everyone involved, while the actual amount of money entering the system stays flat. And it doesn't stop there. Microsoft is OpenAI's biggest customer, funding their compute needs. Microsoft is also CoreWeave's biggest customer, providing 60% of their revenue. CoreWeave is OpenAI's GPU provider. NVIDIA has committed to buying CoreWeave's unsold capacity. SoftBank has stakes in multiple nodes of this network, backing both the infrastructure providers and the AI companies using that infrastructure. If any single line breaks, the contagion spreads instantly. Microsoft coughs, CoreWeave's revenue collapses. CoreWeave defaults, OpenAI loses access to compute. OpenAI stumbles, Microsoft's AI investments crater. And NVIDIA's vendor financing turns into uncollectible receivables. The equity stakes everyone holds in everyone else would evaporate simultaneously. It's cross-collateralization at the industry level. Everyone's betting that everyone else can keep growing, keep borrowing, keep building. The moment one major player admits the revenue isn't coming, the entire network of mutual dependencies inverts from a virtuous cycle to a death spiral. The concentration risk here is off the charts. CoreWeave's entire business model depends on Microsoft continuing to need their capacity. If Microsoft decides to bring more compute in-house, which they're already doing, or if their own AI revenue disappoints and they cut spending, CoreWeave is left with billions in GPU assets and no one to rent them to. Those assets can't easily find new tenants because the configurations are often proprietary. A data center optimized for Microsoft's workloads isn't plug and play for someone else. This financial engineering creates a shell game where everyone looks solvent because they're lending to each other, investing in each other, and buying from each other. The actual source of that cash, paying customers using AI products, is the weakest link in the chain. Everything else is leverage built on leverage, equity stakes in companies with equity stakes in each other, circular flows of capital that look like revenue but function like the mother of all Ponzi's. And the debt underneath all of this? Well, that's been carefully structured to stay invisible. And these tech titans look cash-rich on paper. Record profits, fortress balance sheets, they're the safest bets in the market. Or at least it looks that way, because the debt financing the AI buildout isn't sitting on their balance sheets. It's been packaged into special purpose vehicles, or off-balance sheet structures that keep the leverage invisible to investors doing casual due diligence. Take Meta's $29 billion deal with Blue Owl and PIMCO, for example. They build a data center through a special purpose vehicle, or SPV, a separate legal entity that Meta owns just 20% of. Meta then leases the facility back for 15 to 20 years. The arrangement delivers billions in funding without adding a dollar of debt to Meta's consolidated financials. The liability exists, the obligations are real, but they're hidden in footnotes and structured to look like operating expenses rather than borrowed capital. Meanwhile, Google is guaranteeing $3.2 billion in junk bonds for TeraWulf to support their tenant, FluidStack. You've got investment-grade Google backstopping non-investment-grade debt, so a data center operator can build capacity for a tenant with uncertain cash flows. The credit risk is real, but it's 3 steps removed from Google's headline numbers. Oracle raised $18 billion in a 4-year loan at remarkably tight spreads because the market trusts Oracle. But Oracle is leasing its GPU capacity to OpenAI while it's burning cash at an unsustainable rate. The loan looks safe because it's backed by Oracle's credit. But the actual business model, rent GPUs to a company losing billions monthly, is insane. If OpenAI can't pay, Oracle is stuck with infrastructure financed by debt it still owes. And then there's the pure junk. CoreWeave borrowed at 17% interest rates, and that's what lenders charge when they think there's a real default risk but the yield is too juicy to pass up. And who's providing this capital? Private credit funds, which have poured $450 billion into the tech sector over the past year, up $100 billion from the year before. Private credit is pension funds and insurance companies chasing yield in low-rate environments. They're lending to non-investment grade companies at double-digit rates because treasury bonds don't generate the returns they need to meet their obligations. When these loans default, as loans priced at 17% tend to do, it won't be tech billionaires taking the hit. It'll be your retirement account. The fun part is how the debt structures create cascading dependencies. Data centers are built with short-term construction loans that need to be refinanced into long-term debt once the facility is operational. But that refinancing depends on having creditworthy tenants with long-term leases. If the tenant's cash flow is uncertain, the construction loan can't be refinanced on favorable terms. The developer is stuck with expensive short-term debt on an asset that can't be easily sold because the tenant's proprietary equipment has no resale value. So, everyone's liability is someone else's collateral. The whole structure depends on nothing breaking. If you think I'm being alarmist about the credit risk, just listen to Jensen Huang's warning on Nvidia's latest earnings call. Amid these celebrations, he slipped in a warning that customers' ability to, quote, secure capital is becoming a potential brake on growth. In other words, they know their customers are running out of money. So, what does the peak of this bubble look like? Well, one day we might look back and pin it on the October 2025 IPO of a company called Fermi. Their business model? Provide a nuclear-powered data center megacampus for AI workloads. Their revenue? 0. Their assigned tenants? 0. Their secured power connections? 0. They went public with a pitch deck and a prayer, and the market lavished on them a valuation that would make pets.com blush. When you can raise billions on the promise of infrastructure with no users, money, or electricity, the demand has got to be near. Sooner or later, the first domino is going to fall, and when it does, the cascade that follows will be messy. Inference revenue doesn't materialize at the scale everyone is betting on. AI companies can't afford their GPU purchases and lease payments. Data center operators lose tenants or see lease renewals collapse. The construction loans that finance the build-out, typically 2 to 5 year contracts that assume the built facilities will be profitable enough to get a real mortgage later, come due. And what do you know? They can't be refinanced as long-term debt because there's no stable cash flow to underwrite. Developers are stuck with expensive short-term obligations on assets they can't sell because the tenant's proprietary configuration make the facility worthless to anyone else. And then there are the timing mismatches that ensure nothing fails in an orderly fashion. A GPU's useful life is 3 to 4 years, but the loans financing them run 3 to 5 years, and the take-or-pay rental contracts span a similar range. None of these line up. Data center tenant leases run 5 to 10 years for hyperscalers, but the term loans refinancing the construction debt stretches 10 to 20 years. Every layer of the stack operates on a different time horizon, which means when one piece breaks, the entire cascade happens in slow motion, just fast enough to be unstoppable, just slow enough to be agonizing. As I mentioned earlier, the contagion won't stop at tech. Leveraged ETFs tracking AI stocks magnify every move in both directions. So a 10% drop in the underlying holdings becomes a 20 or 30% drop in the fund. AI corporate debt is now the largest segment in the investment-grade market at $1.2 trillion. When defaults start, they ripple through bond portfolios that thought they were holding safe assets. Moody's recently made it easier for energy providers to issue hybrid instruments to fund power infrastructure for data centers. That's another layer of leverage built on assumptions about AI demand that may not hold. State and local governments handed out billions in tax breaks to attract data center construction, betting that facilities would generate jobs and economic activity. If the data centers sit half empty or get repossessed, those municipalities are left with stranded infrastructure and missing revenue. And this is what Hyman Minsky called Ponzi finance, when borrowers can only meet their obligations by borrowing more or selling assets at inflated prices. The cash flows don't cover the interest, let alone the principal. The entire structure depends on asset prices rising forever and new money constantly coming in. The second either stops, insolvency reveals itself instantly. So, it's very simple. Either AI generates trillions in consumer revenue like yesterday, enough to fill that $500 billion hole and justify the buildout that's already happened, or the financing structures unwind. The special purpose vehicles, the Human Centipede equity stakes, the GPU-backed loans, the vendor financing dressed up as an investment, all of it collapses when the cash flows don't materialize. And while you're waiting to see how this shakes out, why not check out this video to catch up on the latest in the field of humanoid robotics? And if you don't think ChatGPT could take your job because it lacks limbs and fine motor skills, don't worry, they're working on it. That's all from me now. As always, thank you very much for watching, and I'll see you the next time. This is Nick, over and out.